Good evening and welcome to yet another Commtrendz Research podcast. My name is Gnanasekar and I am a market research analyst in Commtrendz Research. We are a commodity and foreign exchange advisory firm who specialize in price risk management of commodities and currency. We have worked with leading corporations in India and in overseas. We are ranging from top corporates to mid corporates who are actively facing price risk and need an organization to actively time their purchases as well as manage their risks. So from time to time, we bring together industry experts through these podcasts that we make to help market participants better understand major developments in the global markets. And today we find ourselves in an environment where geopolitical conflicts, very varying monetary policies, trade disruptions, rapidly changing macroeconomic conditions are constantly challenging conventional market narratives. So during such periods of volatility and uncertainty, experience is something that becomes invaluable. So looking beyond the daily headlines and understanding the broader forces driving the market, it is often better to rely on expert opinions of the people who have been through this grind time and time again. So before we begin, I want to give a brief disclaimer. This podcast is intended purely for educational and informational purposes. So the views that we express here should not be construed as investment or trading recommendations. So please consult with your financial advisor before making any investment decisions. Right. Now, it's my pleasure to introduce our distinguished panel. Our first guest hardly needs an introduction. Mr. G. Chandrashekhar, he is one of India's most respected commodity market experts. He served as the commodities editor at the Hindu Business Line and was formerly the economic advisor to the IMC Chamber of Commerce and Industry. He currently serves as an independent member of SEBI's Commodity Derivatives and Advisory Committee, and he is also an independent director on the boards of several corporates. His knowledge, expertise, and his views are closely followed by policymakers, traders, industry titans, market participants all across the globe, as well as in India. He is also one of the co-founders of Commtrendz Research, established in 2004. Sir, it is an absolute privilege to have you with us again today. Thank you for rejoining the Commtrendz podcast. So our second guest, Mr. Gnanasekar Thiagarajan, he is the current managing director of Commtrendz Research. He began his career with Dow Jones along with several renowned technical analysts before moving to Scotiabank as a commodity trader. So Scotiabank is one of the largest bullion banks in the world. And of course, along with Mr. Chandrasekhar and Mr. Yashwant Rao, formerly head of strategies in Reliance Industries oil and gas business, he co-founded Commtrendz Research. He has also played a very important role in developing commodity market participation during the formative years of the MCX. And his views are widely recognized across print media, television, on commodities and foreign exchange markets. So he has opined multiple times in the papers as well as given interviews on TV regarding commodity markets. Gnanasekar, welcome to the podcast once again. It's a pleasure having you. So, so before we begin our discussion, let me briefly set the context. Over the past few months, markets have witnessed extraordinary amount of volatility. Crude oil has been driven by geopolitical tensions. The price has been stretched from high to low, and concerns over supply disruptions in the Middle East are driving the market presently. Even gold and silver have experienced sharp swings as investors continue to balance both safe haven demand and the expectations of global interest rates, which are changing on the daily as the outlook for what could happen tomorrow in terms of prices are very, very murky because the fundamentals are changing minute by minute. So, with such uncertainty remaining elevated, I think understanding both the fundamental and the technical outlook, bridging these two concepts together has now become more important than ever. So, with this, I would like to hand it over to our participants. The first question, I would like to hand it over to our esteemed speakers. The first question, let's begin with crude oil. This is for you, Chandrasekhar sir. From a macroeconomic and geopolitical perspective, how do you see the crude oil policies, OPEC plus decisions, and supply risks evolving following the recent US-Iran conflict? And more importantly, what factors do you believe will have the greatest influence on oil prices going forward?
Thank you, Kaushik. I think we are in a very interesting juncture. And if I may say so, we are actually at a crossroads.
Hmm.
There is an agreement between US and Iran. There is a ceasefire which was announced. But it was only 2 days ago that the ceasefire was actually called off. And in the last 2 days, we find military action, missiles being fired, etc. And therefore, crude oil, Brent, which very sharply declined well below $80 a barrel and came closer to $70 a barrel, has actually bounced back.
Yes.
I don't track prices on a daily basis, but I know probably yesterday it was $76 a barrel.
No,
Number
you're
one.
very right,
And
sir. It was.
right, and if the hostilities continue, and I suspect it would most likely continue at least for a few more days, then I won't be surprised if Brent were to go above $80 a barrel. This is the first proposition. There is a very interesting, what should I say, a dogfight between the production on the one hand, but lack of movement on the other. Hormuz, the Strait of Hormuz used to actually handle as many as 140 ships every day before the military action began. It declined. There was a blockade, and therefore there was no movement at all. After the
Absolutely.
ceasefire was announced, then again movement of ships very gradually increased. And if I remember correctly, on the 24th of June, the record says as many as 78 ships passed through the Strait of Hormuz. But after that, it has actually slowly dwindled in the last 3 or 4 days in particular for two or
Hmm.
three reasons. One reason is that the strait has to be mined. Like you have land mine, you also have sea mines. Iran has planted a very large number of sea mines. And it's
Right.
not going to be easy to demine the Strait of Hormuz so soon. It's going to take several weeks, possibly several months. And therefore, I don't expect the movement of ship and particularly energy-related cargo through the Strait of Hormuz to normalize anytime soon. I would think at least anything between 3 and 6 months. That normalization would be 140 to 150 ships per day. This is number one. Number two, what is also important is producing countries in the Middle East, in the Persian Gulf area, are also finding other routes, how to bypass the Strait of Hormuz and then reach the markets. For Oman and the International Maritime Organization have actually announced a new safe corridor for transits close to the Omani coast. And therefore, that is being used. And therefore, on the one hand, there is extraordinary caution for ships to use the Strait of Hormuz. Producing countries, they are also finding ways and means of bypassing the Strait of Hormuz and finding other alternative routes. And therefore, ship traffic is increasing quite gradually because mine
Got
clearance
it, sir.
is a major challenge. And therefore, The recent attack in the last 2 days that we are reading in the papers is actually not a good news for oil consumers, not a good news even for oil producers for that matter. And because of this revised, renewed military attack and missile attack, I find a lot of speculative capital, which is once again come into this market, and it's having a disproportionately larger impact on prices. And therefore, it is extremely important for us to know how things are going to pan out, but no one knows. To be honest, no one knows because the situation is so dicey, it's so unpredictable. On the other hand, look at the demand side. Two things. One, the International Energy Agency has said that in the second half of the year, there will be a supply shortfall of about 3.8 million barrels a day. But at the same time, the demand side, to my mind, looks reasonably robust because countries like the US and others, which have drawn down their stocks over the last 3 months, will have to replenish the stocks. And they'll be very keen to replenish the stock. And therefore, that will generate a demand for crude oil. And therefore, on the one hand, there is a dip anticipated in production. On the other hand, there's going to be demand for replenishing depleted stocks. But at the same time, some of the countries like Saudi Arabia, Iraq, Iran, Kuwait, they're all ramping up their production. In the last 2 or 3 weeks, they have started to ramp up their production. UAE, for example, has actually exited the OPEC, and UAE is very keen to ramp up its production. Iraq is very, very keen to ramp up its production. And therefore, while there is a keenness to ramp up production, there is also demand to replenish stocks in some of the countries like the US. The passage for the ships to move still remains constricted, still remains restricted, and all this is going to have an impact on Brent prices, particularly on the forward curve, and therefore the time spreads actually between the price difference between various contracts, as you know, narrowed significantly until about 4 days ago. But now they are, because of the renewed military action, they are again widening. So this is a very, very extraordinary, very difficult, most unpredictable situation that has arisen in the last 2 or 3 years. We can take a bet on oil prices, but we can't bet on the politics of the war and the geopolitical situation. Absolutely. And therefore, we are in an extremely tricky situation. And I would think those who have exposure to the oil market should continue to monitor the developments closely. Do not take far forward position because we don't know what's going to happen 3 months or 6 months from now. And therefore, you need to buy hand to mouth. If you have stocks to replenish, do that replenishment, but wait for the market to settle. How and when it will settle, very, very difficult. At least I have no clue. This would be my response. Yeah.
Understood, sir. Thank you so much for your perspective on this issue. I don't think I have even heard someone come down right to the amount of mines that are there in the sea and how it could affect the supply and demand of the crude market. So that was very enlightening for me, sir. So the same question for Gnanasekar, but with a technical standpoint. So Gnanasekar, what are the charts telling you? Since we are technical analysts, we do know that events like this, the market usually tends to move on, and which is also reflected in the price. But we haven't seen any signs of that yet. So are you seeing any significant support levels, resistance levels, or any patterns that market participants should closely monitor?
Yeah, thanks, Kaushik, and nice to be here alongside sir. As always, ever in gratitude, sir. Thanks so much for being here. Um, so the thing is, whatever little I know is thanks to all the knowledge that I've picked up from him and worked with him alongside in many ways. Uh, the technical picture, to be honest, has never been so challenging in the last 20, 25 years that I've been seeing these markets very closely. It has never been this difficult because the flip-flops that are happening on both the sides. Uh, Morning, you have a different set of news that tends to, uh, have an impact on the market. And evening, it's exactly the opposite, which means that both are trying to contradict each other, or one is trying to somehow push an agenda that the other person doesn't want to. So the warring between the two countries has just gone beyond the level because unlike the other geopolitical situations that have happened, like let's say Russia, Ukraine, has never been this direct that it has impacted energy prices. It did to some extent, but then the market kind of got used to it. If you remember back in 2022 when they started Russia and Ukraine, there
Yes.
was an immediate impact, but just got used to it and moved on from there. And it dropped all the way from 120 odd dollars back to 50, 60, where I was kind of pleasantly surprised when I saw it this time also, and I was hoping that it will settle here. But again, the conflict is back with no signs of any resolution. So that's a very, very tough thing at this point in time to even rely on charts, to be honest, because it's all about what these two, are trying to resolve and the kind of statements they come up with from time to time. And no one has a clear idea what is going on there because of the blockade that has happened. So no
Correct.
one, I think journalists are not allowed, both the sides. So it becomes very, very difficult to get a real picture of what is going on. And that's where I see this mixed picture as far as the charts are concerned. So having said that, I might want to just share the chart here and just tell me if you're able to see it.
Yes.
Yeah. So this is the WTI. I prefer to show the WTI chart rather than Brent because it's a benchmark and it tends to be more liquid and moves in tandem with the market sentiment than Brent. So we saw the low of close to $67 just 2 3 days back, and then a very
Yeah.
sharp bounce from there. Ordinarily, this seems to be a bottom, but these are extremely difficult times. So it's very unfortunate that we are not able to pinpoint and give any clear support resistances. But my very educated guess at this point in time, just purely based on a little bit of experience in chart, is that it's going to sort of go towards the 85, 87 kind of area and find resistance there. But if things
Hmm.
worsen from there on the geopolitical front, then we could be back to close to 100, 95 to $100 again. But having said that, there is already a sort of inclination by OPEC to keep increasing production. Because I think OPEC clearly understands the demand destruction that's happening overall. And I think there's a very clear inclination from OPEC Plus to keep increasing production. So there will be a cap. It's not that it's going to just rally like that before. And as it is, market has got used to this skirmishes overall, and they won't give too much of attention. So it'll all be priced in most likely. So the 85, 87 could be a very strong barrier at this point in time. But it's inclined to go there the way things are happening now, with no hopes of the resolution. Again, the market will start pricing in some tightness. But the good part is that it's not that the supply is bad. It's just that it's constricted now and then. Like Sir said, I think the ships have to some extent come out of Hormuz, but still large portion is still stuck. Uh, I think it's going to be a case where the market will move on from here. Maybe there'll be a positive reaction in the near term, but my guess is it will be back to the 70s or even close to 65 subsequently, not immediately though. So I think a month or two is going to be like this with a mildly bullish undertone. But after that, I think prices are going to slip back and come down lower. Yeah, back to your question.
Understood.
Jnana, from what you're saying, what your charts are saying, I think it's actually in some way an alarming situation.
Okay.
If prices were to move up to 85, 87, or even saying it potentially could reach $90 and above, I think it's going to put all the importing countries, emerging markets, particularly Asia, South Asia, Southeast Asia, under enormous pressure. So let's see, we can only pray, hope, and wait.
Yep.
Right. So, based on what our speakers are saying, there could be very real and very adverse consequences for importing countries, especially for India. So I would urge our market participants to be on the watch for any new developments in the crude markets. So next, what we will be speaking about is gold. So I will be asking this question to Chandrasekhar sir. If geopolitical tensions begin to ease or even intensify from current levels, sir, how do you think that could alter gold's fundamental price floor and its perception as a safe haven instrument? Because what we have seen lately, that the safe haven demand has not been actively priced into gold as much as we had hoped to, especially in peak war times. So, what is your take on this, sir? And please do enlighten us.
Usually, gold is known as a safe haven asset. It's known for known as a hedge against inflation, etc. The current behavior of gold, in my view, actually disproves both of this.
Absolutely, sir.
Okay, that's number one. Whether it is an aberration or whether this is a new norm, we don't know. That's number one. Number two, very clearly, the current geopolitics is driving gold prices. Gold has been under pressure over the last several weeks, and even it broke below the psychological $4,000 a troy ounce level because the price action is increasingly reconnecting with the bond yields and reconnecting with the dollar. Okay, and therefore, if gold price has to rebound, to me, I see the prospect of gold price rebounding extremely limited at this point of time, or rather non-existent, even if I may say. But for prices to rebound, what is required? One, the real yields have to ease. ETF liquidation should slow, or the Fed's rhetoric, the meetings rhetoric, the minutes of the meeting will have to become less hawkish. None of this, in my view, is going to happen. And the dollar, in my view, will continue to remain strong. Bond yields will continue to remain high. There is a very strong possibility emerging now that there will be a rate hike, at least one rate hike before the end of the year. Forget about rate reduction. Earlier this year in January, we were talking about 2 or 3 rounds of rate cuts by the US Fed. No, those days are over. There's a possibility of a rate hike. There is a 60 to 40 chance of a rate hike or no rate hike happening. Okay, but rate cut is ruled out very, very, very simply. Therefore, I'm actually thinking in my view, in the second half of 2026, gold will continue to remain range bound. Gold will continue to remain challenged. And gold, therefore, I think gold is no more a 2026 story. Gold may possibly become a 2027 story. We don't know what's going to happen 6 months from now or 3 quarters from now. It may be a 2027 story, but it is certainly not a 2026 story. That's number one. Number two, everybody talks about central bank purchase, huge demand, etc. But if you look closely at the real numbers of central bank purchases, 3 years ago, it was 1,100 tons purchased by central bank. The following year, 2 years from now, it declined close to 1,000 tons. Last year, it came just about 900 tons. And my sense, most likely in 2026, this year, it could be just about 750 or 800 tons. It means central banks continue to buy, but the rate is actually declining. Because which central banker is a fool to hold or buy gold at these, in my view, unreasonable prices? Gold has, in my view, no business to trade at $4,000 when its own cost of production is less than $2,000 a ton, an ounce. Sorry. The point I'm making is that it is today trading at an unreasonable level. There has been, in my view, and pardon me saying this, huge hype about gold, about geopolitics, about safe haven investment, about central bank buying, etc. But in my view, all these are overhyped stories. My expectation is that the dollar will continue to remain strong, at least for the second half of the year. The bond yields will continue to stay elevated. That will continue to put pressure on gold, because the dollar now is firmly back in control. Okay, at least in the short term, the next 2 quarters. People last year were talking about debasement of currency, etc. That talk has completely faded. Nobody is talking about debasement of currency, and therefore these are factors which I'm sure would weigh on the minds of investors. And those investors who bought at prices above $4,000 an ounce would obviously try and release the stories of huge upside potential for gold. With due respect, I respect everybody's views, but my own view is that at least in the short term, in the second half of this year, it will continue to remain under pressure, and therefore the investors have got to be cautious. Number one. The third point is physical demand. Physical demand in major markets like India are completely enervated. People just have no money to spend, and with the kind of rainfall that we are facing in India, with a kind of risk to our kharif crops, which will in turn become a huge downside risk for rural incomes. I think I won't be surprised if there is a further fall in Indian physical demand for gold jewelry, which will also have certainly an impact on gold prices, and therefore the prices are currently being driven by speculative investment and investors, and not by the real physical demand as far as gold is concerned. And therefore, I don't want to give a price forecast or a price outlook, but I will only say that gold is under pressure. Gold will continue to remain under pressure, and gold will continue to trade in a fairly restricted range until the time, say, the dollar index stays between 98 and 102, and then bond yields stay at a fairly elevated level. This is my take. Yeah.
Right, sir. And interestingly, Sir's views are very much reflected in the price as well. Our previous podcasts had spoken about how gold is going to crash after reaching its peak, which is at $5,600. And as our experts have been predicting, the markets have been moving. The same question to Gnanasekar. So, from the technical picture, what is what looks like a potential bottom for gold? Where do you think market participants could start investing and buying in gold again? So, based on your analysis, where do you see gold potentially trading by the end of 2026?
I think putting all the factors that Sir just mentioned, and especially the dollar, because that's sort of going to give you a direction, and I'm completely in agreement with him as far as the dollar strength is concerned, because of the
Yeah,
potential rate hikes that are expected. Though Trump wouldn't like it, and he would put as much pressure to ensure that there isn't a rate hike. Uh, the possibility of that is increasing day by day the way the conflict continues. But hopefully, in between, if all settles down and if there is a resolution to this crisis once and for all, not like a ceasefire where it is resolved once and for all, then you might see the dollar taking a big beating. But that's a big if. We really don't know how it will happen, if it will happen, when it will happen. So that is a big question. So in the absence of clarity there, I think the dollar strength is imminent now. And with a possible rate hike on the cards. Uh, that could diminish the appeal for holding gold. Because what happens is when rate hikes potentially happen and treasury yield starts going up, then gold as a zero yielding instrument, because it doesn't give you a dividend, it doesn't give you any like a fixed deposit, that there isn't any interest rate attached to it. Uh, though a very minor portion is there in India. I think in India you get a very very small interest rate for holding it. But globally, neither the central banks who buy a big amount of gold or big holdings of gold have never given any returns. So in a rate hike environment, it is it's a it's not a loss making phenomenon. It just doesn't make sense to hold gold
understood.
because you keep losing on the cost of carry. So that is a huge problem as far as gold is concerned. So the scene is that the undercurrent is bearish because of this. It is not the actually the geopolitical situation should have ideally given it tailwinds, but that's not happened in gold simply because of the discouragement coming from the interest rate side. It just discourages you from holding gold at all. But having said that, if one looks at the price picture, because market has the ability to price in most of these factors. So looking at that, I can't say we are at a bottom or near a bottom. Still feels a little far away from bottom in place. But what I clearly see is, let me just open the, sorry. So what I clearly see is markets trying to find some kind of a support, but it's unable to. So that's a very clear sign that there is no follow through buying. It tries to recover, but then it fizzles out very shortly. So these are all clear signs of a market under pressure. So what we're seeing here is where we are right now, 4,120 or so. Uh, it is trying to recover from the recent lows of 3935 it made. But
Yeah,
purely from a technical perspective, yes, there is some bit of an upside, which means that there could be some hope on the Middle East situation. There could be some hope. I'm not very bearish on the price at this point in time because we've already seen a very strong retracement all the way from 5,500 to 3,935.
Absolutely, as we have spoken before in our other podcasts.
Yeah. So we are going to see some kind of a retracement back to 4,400 or 4,500 odd levels. That looks more likely to me, but will it sustain there? Taking into account the possible rate hikes going forward. To me, this looks more like a retracement which could fizzle out soon. So yes, there is some upside in the near term, but absolutely not sure if it can sustain and follow through and keep going higher from there. Back to your question.
So interestingly, I had another question on the chart front. From my very limited knowledge on technicals, what I have learned from you and various other mentors in the markets, I can see two very distinct patterns in the chart. One is the head and shoulder top, but once that has materialized, there is another pattern that I can see, which is a bullish divergence. Could you give a little bit of an explanation to our market participants as to what exactly is a divergence and how it impacts the price?
Very quickly, Kaushik, instead of going into all these deeper points, it's very simple. I think the head and shoulder is not a perfect one. It's sort of I would say, an ugly head and shoulder. It's not a clear one, which is why, once the neckline is broken, it has found some support. Now, the divergence you're talking about is a positive divergence across the board, and other indicators also, which sort of says that the downtrend has come or has been arrested. Not that it's over. It just says that it's been arrested. So there's a floor for the downtrend as of now. Uh, and normally this comes at an end of a decline. So that sort of indicates that yes, that's the reason why I'm expecting some kind of a minor uptrend in the near term. Honestly, there aren't any fundamental factors to support this kind of an uptrend, but technically there are signs that it can strongly bounce back from here. Uh, like I said, markets have this ability to price in all these negativities. So
Absolutely.
my feeling is it's kind of getting priced in, and that could be a minor rally in the offing. Yeah, back to you.
Got it. Thank you very much for enlightening us with your technical perspective. And as I also very strongly believe, technicals are very important in the assessment of the price. Simply because all known and unknown information has already been factored into the price, and therefore he who tracks the price has a competitive advantage over he who tracks, let's say, purely fundamentals. Anyway, so that is my my take on how technicals can impact the process for an investor. So we will move on to the
Kaushik,
next commodity.
I want to add another dimension to this story.
Yes, sir.
Look at the US and of course around the world.
Hmm.
How artificial intelligence, AI, is significantly impacting growth,
Right.
and how some of those large companies who went in for IPO uh, uh, succeeded in garnering huge amounts of money.
Yes, sir.
One reason for gold to be under pressure is also people have sold gold to be able to invest in
I
shares
see.
of companies which went into IPO. Number one, those are big
Hmm.
numbers that we are talking about. Number one. Number two, there is a strong expectation, although there is no evidence as of now, but evidence may follow. There's a strong expectation that AI will lead to better productivity and better economic performance, particularly in the United States. If
Hmm.
AI leads to better economic performance, the stock market should continue to boom, should continue to perform very well. And when the stock market continues to perform well, those less committed investors in gold will actually exit their positions and come into the top.
Understood, sir.
And this I see as a real possibility happening over the next 6 months. Personally, I have no stake. I don't trade. I don't hold any trading position.
Yeah.
But I will not be surprised as a student of this market and somebody who's been watching all of this. Gold can break below $4,000 an ounce and come closer to maybe $3,700, $3,800 an ounce. I will
Right.
not be surprised if that were to happen, but that will depend on several conditions, like the strength of the US
Absolutely,
dollar,
sir.
the risk of the interest rate hike, the bond yields, the strength of the US economy, and the equity markets booming, etc. Therefore, there are several reasons, but all these are interrelated. Economic growth, consumer confidence, interest rates, bond yields, strong dollar, all these are in some way interrelated. Therefore, there is a possibility that gold will find itself under increasing pressure. Yeah. And
Understood,
could
sir.
potentially fall reasonably well below the psychological $4,000 mark. Possible.
So I am going to digress a little bit and ask a follow-up question on the AI complex. So as we know, most of the AI stocks and tech stocks which are in correlation with AI, let's say memory or even processing, these companies have seen a massive boom in their prices. Some even going up to 100% or even 200% within a year. So when this is happening, what do you think it would create? And would it create an image of a bubble in the market, let's say like an AI bubble? And how would that impact the market participants? Sir, you're on mute. So
Who are you asking this question to?
you, sir, Chandrasekhar, sir.
Me? Oh, okay.
Yeah.
No, it's like this. Very clearly, there are people talking about AI becoming a bubble. My sense is it's too early to call too early to take any call. But there is an extraordinarily strong possibility that AI will improve productivity. And
Right.
productivity improvement would always bring gains, not just for the corporates, but for the whole economy as a whole. Number one. Productivity gains may potentially lead to some job losses, particularly because of what artificial intelligence does, AI does, and it can to a significant extent replace a human endeavor. But that does not mean that everyone is going to lose jobs. It's not so. It doesn't work that way. Therefore, AI to become an absolutely widespread, for AI to be adopted in a widespread manner is going to take time. But as the world, as the economy begins to get adequate evidence about productivity increases through inclusion, through infusion of AI in their business activities, I think there'll be a lot more confidence in the very positive outcomes that AI can generate for the corporates, for the businesses, and for the economy as a whole. And that can also lead to actually cost reduction. Instead of raising costs, it can actually, productivity increases will always lead to cost reduction. And that obviously will have a certain impact on inflation. Okay, and therefore it's a fairly complex situation. It is not a binary yes or no or white or black.
Yeah,
I think it's a fairly evolving situation. There are gray areas, and therefore we need to wait and watch for the evolution of this situation. But it's very, very interesting times over the next 1 or 2 years in my view. Thank you.
Very true, sir. Contrary to what the market has been indicating when it comes to AI, I actually completely agree with you. The amount of growth that it has driven in the globe presently just shows to the potential that it can have in the coming years. So yeah, back to commodities. So my next question is about silver. So let's turn our attention to silver. The recent disruptions in the energy markets have once again accelerated talks and discussions around energy security, energy reliance, and as well as alternative renewable energy investments. Chandrasekhar sir, do you believe industrial demand from the green energy transition can continue supporting silver prices even if global economic growth slows down and interest rate hikes or declines impact gold very strongly? Do you think the same is not true for silver because of its industrial demand? So that is what I wanted to ask of you, sir.
Yeah. It's a fairly tricky question to answer, but there are two aspects. One is that usually silver rides, as I say, on the coattails of gold. Okay.
Yeah.
And if the gold prices increases, silver follows. If gold price collapses or falls, silver would follow, etc. All of that. But over the last 2-3 years, what we have found is two things. One, I think it's the fifth year running that gold, the silver market is in a state of deficit. This is the first proposition.
Right.
At the same time, demand for silver for industrial application is rising. Unlike gold, okay? Unlike gold, silver has real consumption. And that word real consumption is very, 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 very important. And therefore,
Very true, sir.
as the world moves rapidly towards energy transition, and if crude oil prices continue to stay about $75-80 a barrel, the energy transition will only be accelerated. I think the demand for silver will continue to remain robust. Economic slowdown, I personally believe 2026, I expect China's growth to be at about 4.5% GDP growth. The US growth could be about 2%, even 2.1%, etc. Therefore, major economies will continue to grow. And therefore, and they're also into energy transition. And therefore, demand for silver will continue to stay fairly robust. And therefore, I'm not actually bearish on silver, but I'm not too bullish either. I'm not saying it'll breach $100 and go above that, etc. But I think it could trade in a range, but the physical demand for silver will continue in a fairly robust manner. And I don't know what the current prices are, but my own sense is it has the potential to go to $60 or $65. Is my sense. Yeah. Unless it's already reached that level, I don't know.
Yeah. No, not yet, sir.
Sorry.
Not yet. It's not.
It's not yet. Yeah.
Maybe Gnana from a technical point of view can throw more light on that. Yeah.
Sure.
So, Gnanasekar, from a technical perspective, what does the gold and silver ratio indicate? Do the charts suggest that silver has some scope of outperforming gold in the coming months? What is your take on this?
Yeah, I think it looks like it clearly can outperform gold to a great extent because you can see there are many things that have supported this decline. Somewhere near the 55 kind of a range. So that's a very strong support. You have a long-term trend line that supported it, and then it came very close to a 61% retracement around 54 cents. So there are confluence point, what we call this in technicals is a confluence point, where more than one indicator is indicating that the price is found support near a very important level. So purely based on that, my sense is the downside is clearly limited. Wherever it goes down, it's going to be very limited for silver from here. And like Sir said, it has upside potential, but again, not like a massive potential like before, where it went to dizzy heights around 120 and then couldn't sustain, came all the way back. But US still maintains the rare earth mineral status as far as silver is concerned. So there will be demand that will resurface from time to time, and with this energy price issue that's taking place, there is going to be more reliance on alternative energy, solar panels, and that in turn adding to silver's increase in industrial demand to a great extent. So, sir is absolutely right in saying that the downside is going to be limited from here. And technically also it gives a clear indication that from here, it's not going to fall, but it's going to grind higher gradually from here towards 75 or so. That will be a cap. It needs a lot of positive factors to break that 75 and then move higher towards 85 or maybe even higher. But there's absolutely no indication right now it can do all that. For now, it has a scope to maximum go up to 74-75 cents on the upside. That again depends on many things, based on the dollar strength or weakness. If the dollar strength continues, I don't think even that can happen. It will very gradually move towards 65, struggle there, maybe move in a volatile range for some time. So the current volatile situation is going to continue. The current consolidation is going to continue in silver for some time. But what I'm seeing more importantly than all this is the dollar rupee. The dollar rupee is also going to play an important role in both gold and silver price as far as the price is concerned. So, hoping that there will be a lot of inflows because the government has done a bit to open up inflows. That hasn't really materialized into actual inflows that they expected. So the rupee is back on a depreciating spree. We're seeing it, gradually move back towards the previous highs that we saw around 97, somewhere close to that. And RBI has little scope to keep intervening because the reserves are also depleting. They also run a short book because of the active intervention that they've been doing. So all this hints to me that this depreciation is on the cards again. And typically, historically speaking, July, August, September is a time when rupee depreciates the maximum. If you see seasonally, that's the quarter where the rupee does the maximum depreciation so far in the past. So it might not, it might be the same case this year as well. We are already in July and we have another 2 months to go. So the threat of a depreciation to 98 or even closer to 100 is still on, unless the situation resolves and then there is some hope coming from the Middle East situation. It doesn't look like, at least for the next 2 months. So this depreciation that's going to happen will support local prices. The local prices are not going to go down, even though international prices might be under pressure. So that's the point that I wanted to make.
What do you think are the chances for rupee to depreciate to 100?
I don't see it happening to 100 because I think RBI intervention will be quite strong. But what we're seeing, because that's also going to keep increasing inflation, which will be very sticky for the government to manage. So they will ensure it is at a comfortable level, but at the same time, they have to let it go. You can't keep on intervening and trying to arrest the depreciation. It can't happen. So they will let it go, but they will also ensure that there is certain caps at different levels. They won't intervene actively. They will only intervene when it is really needed. That's the feeling that I get. And with the rate hike expected, with the dollar strengthening globally, there are likelihood that this depreciation will continue and go continue to go higher. So the point is, it's going to support the domestic price. That's the only consolation. Even though you have international prices under pressure, the domestic price will be comfortable. It won't fall much. Yeah, right.
Understood. So I have one question for Chandrasekhar sir. Sir, so I have been closely following something known as Project Vault. So the US government, financed by the Exim Bank of USA, have initiated something known as the Project Vault, where they are actively stockpiling resources which they feel are critical to uh, technical or economical development in the future. Amongst these materials and minerals, silver and copper have been listed as a critical mineral by the
Yep.
USA. Now, when they do this, it creates an image of silver and copper being akin to rare earth minerals, not just an industrial metal. So, how do you think this would affect the dynamic of the white metal and how it could impact the silver market in the future?
This is simply one more segment of demand. Okay,
Right,
stockpiling of critical minerals. It is not only the United States, it is also Europe. Europe recently passed a law whereby they are going to stockpile all commodities which are required for their industrial activity or even food security for that matter, and they will stockpile. The beauty of a policy of stockpiling for any country is once a country decides that we have to stockpile so much quantity of a certain mineral or any resource or a commodity, then that stockpiling will be irrespective of the price.
right,
Supposing the US decides to stockpile copper or silver for that matter. So whether silver trades at $50 or $80, $100, $120, if they have a target to stockpile, they will buy it and create that stockpile, which is something very, very important that we need to know. Copper, for instance, the US government, I mean, Mr. Trump is now toying with the idea of imposing tariffs on copper imports and
exactly.
products that contain copper, 25% tariff or whatever, refined copper particularly. And
Yeah,
therefore, but I think no decision as of now has been taken, but it's been a hanging
yes, sir.
sword. If that were to happen, then the copper within the US will become more expensive, and copper in LME, for example, will be under pressure.
Absolutely, sir.
And
There
and
are
for
signs
that,
of it being under pressure as well
right.
currently.
And there are copper producing companies, copper mines in the US, which have in some way are functioning at very, very substantially reduced capacities in relation to their installed capacity. But maybe those mines will be revived and US itself will start producing more copper. But that's a long-term play. It's not going to happen
Hmm.
overnight. It could take 1, 2, 3, 4 years for those copper mines to become fully operational and fully productive. And therefore, yes, every country would want to stockpile resources which it definitely needs, but it doesn't have in terms of their own domestic resources. And therefore, that will certainly have an impact on commodity prices, but it will have a varying impact
Right,
because it will obviously help the producing countries sell more to the importing country, etc. And therefore, that will have an impact. Also, it depends on the overall quantum of production of that commodity, copper, for example, or silver, for that matter. And therefore, there are multiple factors that will impact prices, but stockpiling generally should be seen as a bullish signal for commodities.
understood. Got it, sir. So that brings us to the end of today's discussion, as that was my last question. On behalf of everyone at Comtrends, I would like to sincerely thank both of our distinguished guests, Mr. G. Chandrasekhar and Mr. Gnanasekar Tyagarajan. Thank you very much for sharing your valuable insights and your combined decades of market experience. So we are very grateful to have your voice and your opinion in our podcast constantly. So we hope today's discussion has provided our viewers with some, let's say, semblance of a better understanding of the key forces that are presently shaping the commodity markets, and as well as all the risks and the opportunities that lie ahead. If you found this discussion useful, if you found our views and our takes on the market useful, please do like and subscribe to Competence Research. Do share our views to the the relevant people whom you feel would benefit from this. Our As I previously mentioned, our market insights are purely for educational content. We are not promoting any trades or calls through these podcasts. And as Sir rightly said, we are all students of the market. We learn from the market in the daily, and we feel like giving this knowledge to the people who are not in access to them does help giving a small benefit to investors who are actively looking for cues about where the price could go. And if there are any topics you would like us to cover in the future podcasts, please do feel free to leave some suggestions in the comments below. We will take your suggestions and we will also try to implement new things, what you feel would benefit you as a user of our podcast. So that being said, thank you for joining us, and we look forward to seeing you again on our next Market Outlook podcast. So until then, stay informed and stay disciplined while trading, and have a wonderful day.
Thank you.
Kaushik, I want to compliment you. I think you anchored this program like an expert, like a pro. Keep it
Thank
up.
you very much, sir.
It's wonderful. Such a delight for me to be part of this conversation. Good luck and God bless you all. Thank you.
Thank you, sir.
Thank you so much, sir.